Welcome to Three Statement Connections. This part will consist of a brief introduction to three statement connections, followed by basic three statement connection questions and intermediate advanced questions as well. So what are three statement connections? Here we try to understand how the three statements are connected to each other and how one transaction affects each individual statement. So analysts and bankers basically need these ideas for analyzing financial statements and making financial forecasts. And because of those reasons, these topics are often asked in investment banking and private equity position interviews. So whether you're participating in modeling courses or technical interview courses or private equity interview courses, this part will be required. So let's go over to the basics and just look at when we need these three statement connections. So there are basically four combinations where profit and cash flow differs. And this is where all the difficulties in accounting starts. If profit and cash flow is equal to each other, there will be no difficulties in any financial analysis or modeling. But when these two are different, now that creates problems. So the main reason is because accounting, as you all know, we use accrual basis, which means that it can differ from actual cash flow. So in the end, usually the consequences are usually the same, but there can be temporary differences which creates asset and liability items on the balance sheet. And we also have to make cash flow adjustments to the cash flow statement. And usually for temporary differences, the transactions will be reversed over time or at some point of time. So let's go over the different types of situations where cash flow and profit, accounting-based profit can differ. First, we have a situation where in the income statement, it is recognized as profit. However, as revenue or profit. However, on the cash flow statement, there can be times where cash has not been actually collected. There can be opposite situations where in the income statement, it's hard to be recognized as profit, but you have received cash. So there was a cash inflow. The first case creates accounts receivables or accrued revenue accounts, where the second case can create accounts like unearned revenue and deferred revenue. Accounts receivables and accrued revenue, because you have already recognized revenue, but you haven't received cash yet. From the company's perspective, you have future benefits. You have future cash to collect. So that is recognized as an asset. It creates an asset. So accounts receivables or accrued revenue, which is rarely used, but accounts receivables can be, of course, seen very often. These two items are recognized as assets. The other case, like unearned revenue or deferred revenue, you have already received cash, and you have to provide to the customers, whether it's goods or services, you have to provide them with something. And because you have now future obligations to provide something, now it's not an asset, rather it's a liability. Same goes with expenses as well. There can be situations where in the income statement it is recognized as expense. However, there has not yet been any cash outflows. And those kind of cases can be seen in depreciation cases, amortization cases. For pension liabilities, bad debt expense, there are numerous cases, but these four, we believe, are the most common cases. Because the company has future obligations to provide, future, cash, such as pension liabilities. Liabilities are created on the balance sheet. Depreciation and amortization are created as a contra account of assets. We'll go over that in future lectures. And lastly, there are cases where profit, there has been cash outflows, but has not been yet recognized as expense in the income statement. And those are items like prepaid expenses, capital expenditure, R&D expenses where it has been capitalized, or inventory purchase. And these types of situations, they create assets, future benefits that the company can now receive. So how are these statements connected? So I highly recommend to our students, whether they're preparing for interviews or whether they're doing financial modeling, to memorize this formula, which can be used in any three-statement connection situations, even difficult ones as well, and even the ones that we're not going to actually cover in our courses. Please remember these formulas. So we always start from the income statement. Remember that the income statement, we always try to capture or gauge the company's performance as best as possible. So start from the income statement. Is this transaction going to be recognized as revenue? Is it going to be recognized as expense from the income statement? And as a result, there's going to be some kind of net income. It can be positive, it can be negative. There's going to be net income, or it can be zero as well. The income statement, net income, has connections to the balance sheet and the cash flow statement. First of all, net income from the income statement becomes the starting point of the cash flow statement. So net income is the starting point of cash flow from operations. Also, net income affects the retained earnings balance in the total equity. So whatever number is on the net income, year-end retained earnings numbers are going to change by the amount changed in the amount of net income. So that's step one, start from the income statement. Step two, let's think from the cash flow statement's perspective. This is actually more easier because all you have to think is, has cash been received, or has there been a cash outflow? So think from the cash flow statement, from the cash perspective, and you're going to eventually figure out how much cash in the end has been outflowed or inflowed by that transaction. Remember that the cash flow statement always makes adjustments. It explains why it started from net income from this number and why it ended in actual cash change numbers. You have to explain why this happens, why the difference. So those adjustments are going to be made in between these two items, and they're going to categorize the adjustments, whether it's related to operations, investing, or financing. So adjustments are going to be made, and that's the end of the cash flow statement. Lastly, the ultimate changes in cash affects the cash balances of the balance sheet at year end. So you can see that the income statement and the balance sheet is connected by net income and retained earnings. The income statement and the cash flow statement from net income and cash flow from operations. The cash flow statement affects the balance sheet with its changes in cash affecting the cash balance in the balance sheet. And lastly, we have to verify whether total assets equals total liabilities plus total equity. And usually there's going to be some kind of difference, and usually that number is whatever account number is affected, whether the account number increases or decreases. So even if you haven't understood the things perfectly, we're going to see a lot of examples. We're going to see probably over 50 examples, so no need to worry at this point of time. Let's start from the easiest type of transactions.